Hi folks, you're welcome back. This is the fourth video for the most important institutional reference point. If you've not watched the previous lessons where I started teaching the 5 most important institutional reference points in their order of importance, I recommend you to go and watch those videos because this lesson was designed to be in sequence. So if you don't watch the other videos, you may not have clarity on what we are trying to talk about in this video. However, today let's get started. If you are coming to this YouTube channel for the first time, I would like you to click the subscription button and don't forget to turn up your notification bell so you stay updated every time I post a video. In today's lesson, we are talking about the fair value gap. This is one institutional reference point that most smart money traders get confused trying to use or apply them during their trading. Regardless of the time frame you are identifying this, the fair value gap is the fourth institutional reference point in their order of importance. Remember, we mentioned the first is mitigation block. Whether the bearish or the bullish mitigation block is the first in its order of importance when you are looking for institutional reference point, especially after price has created a price range and is retracing into the internal range to rebalance the internal range inefficiency. We are looking for first the mitigation block. In the absence of the mitigation block, we will look for the breaker block. In the absence of the breakers, we look for the liquidity void. In the absence of the liquidity void, then we are looking, in the absence of the liquidity void, then we are looking for the fair value gap. So today we're actually going to talk about the fair value gap. So simply put, what is a fair value gap? A fair value gap is an institutional reference point that is usually for rebalancing price action. It is for fair valuation. What do I mean? I'm going to use a very simple analogy to explain to you guys the purpose of a fair value gap in price action. So for example, if institutions are buying BTC USD, which is the Bitcoin, and they've already bought Bitcoin at let's say $20,000, and right now Bitcoin is around $100,000. We already know just by common sense that because it's already overbought, it's not a good price point to continue to buy the BTC USD. All right, so late investors or other institutions who would want to still buy the BTC, but they feel this is not a very good point for us to buy BTC because it is overbought. They will want to buy BTC, but not at $100,000. They want to buy it at, let's say, $40,000. But institutions again are saying, no, we are not going to be selling at $40,000, but we can give you for $60,000. That is what is called fair valuation. It is neither the price that the investors want to buy and neither the price that the other guys want to sell. They are looking for a fair value that's going to be fair for both the buyers and the sellers. That is that gap that institutions would usually leave in price action for future rebalancing and for future pairing up of new positions at the fair value point of interest. That is what fair value gap simply does in price action. I really hope that you guys understand this analysis, but I'm just trying to explain it in the most simple form where everybody can understand what I'm trying to say. So how do we identify the fair value gap? The fair value gap is a 3-candle price action that creates a gap between the first and the third candle. 3-candle price action that creates a gap between the high of the first candle if you are buying and the low of the third candle. So we assume that this is buy candles, the first 3 candles here that are buying, and the first candle has a high. Of course, it has a low. You must have known, I believe everybody knows the anatomy of a candlestick right by now. And the third candle as well has a high and has a low. So in an instance where we see there is a gap in between the high of the third candle of the first candle, so in an instance where we see there is a gap between the high of the first candle and the low of the third candle, that gap is called the fair value. What this means is there is an inefficiency in price action. An efficient price action will start or rebalance this high before price expands. So price will open, rebalance the high right there. This high, you see the high and the low there, they are at the same price point, or even price can even rebalance it a little lower, then continue. That is what a balanced price action means. It's called efficient price delivery. But in a case where we have a gap between the high and the low of the third candle, that is a fair value gap. Again, if we are selling, we have sell candles. Remember I said it's a 3-candle price action where we see there's a gap between the first candle and the third candle. In this case, because we are selling, so once we see there's a gap between the low of the first candle, because we're selling here, and the high of the third candle, that inefficiency in price action is called a fair value gap. Okay, you see that? So institutions will leave this fingerprint in price action so that they can return into them in future to rebalance an inefficient price range before they continue to sell lower. This is how to use fair value gap. Okay, so when we have a price range where price action has taken out an external range liquidity, for example, and has created a shift of market structure bearish, I'm just using an example. As price returns into internal range, we are identifying the fair value gaps by the left here, because institutions will use up that fair values to pair up new positions for the next expansion. All right, this alongside other institutional reference points are the things that institutions are looking for every time they are bringing a retracement into an internal range. They are looking for the mitigation blocks, the breakers, the liquidity void, the fair value gaps, the other blocks, and the other two that are not necessary for us today. Today we're just talking about the fair value is what we are focusing on today. So I'm going to be showing you guys a few examples on the chart, and we're going to see how we're going to apply this fair value gaps in price action. This is actually the dollar index 1 hour chart, the dollar index 1 hour chart, and I want to show you guys how I'm using the fair value gap in price action. So this is a scenario where price action created a shift in market structure bearish, especially after taking out the external range high above that old high. Price action created a shift of market structure bearish. Okay, now we know that we are bearish, and since we are bearish, we're asking questions. Are we just going to start selling here? No, because the retail trader looks at this as a breakout from this small level of consolidation, so a lot of them are selling. But institutions already know that retail is selling, so they have induced retail to start selling, but they have an intention. What is the intention? Is they are going to reprice into the internal range institutional reference point. So in the order of importance, we are asking which one are we going to look for. We're going to identify the mitigation block. If the mitigation block is not there, the breaker, the liquidity void, or the fair value gap. Okay, so here we have a scenario where we have a confluence of a breaker and the fair value gap. All right, so this is a breaker because price took out the high before the shift of structure bearish. So literally that is a bearish breaker. And do you see that we have a fair value gap, a gap between the low of the first sell candle there and the high of the third candle? That inefficiency is called the fair value gap. And when you have a large range fair value gap, we measure 50% of the fair value gap as consequent encroachment. That is a very key price level that institutions would usually tap into when you have a large range fair value gap. So look at how price action traded into the bearish breaker right there, and 50% of the fair value gap there, boom, before the new sell expansion lower. You see that the fair value in use and the breaker block. Again, we have another price scenario. Price action takes out the high there. Let's take a look at it. Price takes out that high and creates shift of market structure bearish right there. That is a bearish breaker being created once more. What do we see? We are looking for the internal range reference points that institutions will trade into, and we have the bearish breaker, the breaker because price took out the high and created shift of structure bearish. So all of this candle is the bearish breaker. We measure 50% of that candle wick also because it's a large range candle wick. to pinpoint the breaker. And do you see that we have a confluence of a fair value gap right there? The low of the first candle and the high of the third candle there. Doesn't matter whether it's a buy or sell candle, price traded into it. That should have been the entry, and price expanded lower. Again, price traded into that same level, the breaker, fair value gap, later in future, and we expanded, created another displacement lower. As price action created that displacement, what do we see? We see price retracing into the fair value gap to rebalance that little inefficiency, even though there's a reason why this was being used. All right, so price traded into that price point and created another expansion lower. You can see that the fair value gap is being in use. Again, price traded below the external range low right there. For every external range liquidity taken, we anticipate price action to retrace into internal range. But what do we see here? This is a liquidity void, a large range price action with a one-sided price delivery. Price mitigated 50% of that liquidity void. You see that? And price created another expansion lower. You see price action expanded lower. Again, another price scenario where price takes out a high, create a shift of market structure bearish, just like you see there. Market structure shift. Okay, then we see price action create a fair value gap right there. You see the gap between the low of the first candle and the third candle, that is a fair value gap. Price traded into the fair value right there before the sell expansion lower. Let's look for examples to the buy side. Okay, just few examples to the buy side, and we're gonna have some of them here. This is a price range where price created shift of structure bullish, and we had the shift of market structure bullish there, the bullish breaker, and also the gap right below it, that is called a vacuum gap. It's also a type of fair value gap or a type of void. Price tapped into 50% of that gap. You see that here before price created that expansion higher. Again and again and again and again and again, you're going to see the fair value gap supporting price action in many places where price traded into the fair value. Subsequently, you're going to learn which one to prefer or which one to pick, which of the fair value gaps you're going to pay attention to as price action is trading. Okay, so let's take a look at this week's price action on the dollar index. This is the dollar index. We see the dollar index actually from Monday created a shift of market structure bearish after trading into the bearish order block on the 4-hour and the 1-hour there. Price created market structure bearish. It may not be clear to the newbies, but for some of you who have been following me, you would agree with me that that is a shifting market structure bearish. When you take out the candle wicks, you're going to have clarity, and you're going to see that it is actually a shift of structure bearish with the bearish breaker right there. Price action traded into the bearish breaker. Remember, we are looking for mitigation, then breaker. Price traded into the breaker there, created that expansion lower. Then we see the fair value gap providing resistance for price action to continue trading lower. You see that fair value, price traded into that fair value gap, created another expansion lower. Again, the fair value gap provided another entry signature right there. You see that the low of the first candle, we have the third candle, price action expanded lower. Again, we have another fair value gap right there. The price action traded into, or even the one there, price traded into it and created another expansion lower. Again, the fair value gap. So we see the fair value gap in many cases, providing support and resistance for price action. In most times when you are buying, the price action will trade into the fair value, then will trade higher. When you're selling, price will trade into the fair value and trade lower. Go to the chart, do your inside study, be able to identify these fair value gaps, because subsequently you will learn how to use these fair value gaps to take entry executions even on the lower time frames or even on the higher time frames to determine the next directional bias. I hope that you learned something in today's episode, and don't forget to join the Telegram community on the description of this video for free signals and free educational content.